My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to America. I'll be one of my friends just trying to make you some money. My job is not just to entertain you, but to educate, teach. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Sometimes I look at the action, and all I can say is, are you kidding me? For example, today, when the NASDAQ roared at the opening before rolling over as the Dow and the S&P surged, at least until the whole market then rolled over at the end of the session, Dow ultimately gaining just 17 points. S&P actually dipping 0.32%, NASDAQ lost 1.26%. I said to myself, this session made no sense at all fundamentally, but technically it will have impact. For weeks on end, we've watched the NASDAQ vastly outperform the more old-fashioned, venerable Dow Jones Industrial Average. And because people like to cook up reasons to explain everything, even when there's no good explanation, we heard a host of arguments about why the tech-heavy NASDAQ has been so strong. For instance, we heard that as long as inflation reigns, the big NASDAQ titans would keep going higher and higher because they don't need to worry about supply chain problems or rising raw costs. True. I mean, Salesforce.com doesn't buy a lot of metal. Microsoft Office isn't getting stuck in the ports, and Adobe will be ready and available for the holidays. We heard that these tech stocks are immune to COVID, that they're what you buy if you think the pandemic's getting out of control again. Then we heard that they're all having magnificent quarters because every business out there wants to digitize and automate thanks to the labor shortage. People nod when they hear these arguments, and I've made some of them. Well, because why? Because they sound like they make a lot of sense. And there's a foundation of truth underneath each one. The tech titans really don't need to worry about the supply chain crisis. They are immune to COVID. They do benefit from the labor shortage. But that's not necessarily why the stocks were outperforming on a daily basis. So when you come in on a daily today where the NASDAQ spikes huge, bad sign always, then reverses, a lot of parabolic charts, you got to question all this conventional wisdom. I mean, okay, so for instance, did earnings suddenly go south for the big tech behemoths? Did people stop digitizing? Are there fewer COVID worries than last week? Of course not. In fact, the COVID worries have only gotten worse. And with the exception of the cheaper oil and some slight easy import congestion, there's no reason to think that supply chain can explain tech's recent outperformance. How do we explain today's reversal then? That's what matters because we're trying to think forward, right? Simple. The gap between the NASDAQ haves and the S&P 500 have-nots had finally become so untenable this morning that money managers, or at least some big ones, decided they had to take profits in tech after a fabulous run-up and swap into something else. No, they're just being disciplined, people. When you get huge gains, you know what you're supposed to do. Bulls make money, bears make money, hogs, they get slaughtered. So you got to ring the register on some. Once again, I heard all sorts of alibis for today's action, like the selection of Fed Chief Jay Powell for another term, which is supposed to be good for the banks and the industrials. You want to own the banks as long as Powell's in charge. At least that's how this line of argument goes. But the more I thought about it today, the more I realized, wait a second, that's nonsense, too. Powell's been in charge this whole time. His renomination wasn't a surprise. And the only other contender, Lael Brainerd, who got the vice chair nomination, would have been just as committed to loose monetary policy. It was almost like she was created for a horse race. I mean, honestly, she's really smart. He's really smart. They share the same ideology. We should not be thinking that it would be that different. Today's action is not about anything logical or newsworthy. In fact, it's really about the rest of the market playing catch-up to tech, for the floor fell out from the whole thing near the end of the session. If I'm right, this move will not, though, be a one-day wonder, even as it seemed to peter out near the close. There will be more Dow and S&P stocks catching bids because the analysts who like these names tomorrow will come out of their caves. They'll now think the coast is clear. I think the Dow and S&P winners from earlier today around noon will be the horses, again, if you want to do the horse race analogy, to bet on between now, say, and the next week or two. Now, you might be tempted to buy the NASDAQ stocks, betting that they're going to come roaring back right now, even if the charts went from great to horrendous, which is what happens when you have a spike up. But I'd rather find companies that did well in earnings season and got trampled on unjustly in the last few weeks because they weren't part of the NASDAQ stampede. That way you can fall back on the fundamentals. Those still matter. And buy more if they end up going lower because they'll be getting cheaper. And they're not done going up if it comes to earnings. Now, regular viewers know that I run the CNBC Investing Club. And I'm totally exclusive to CNBC now. And as part of that club, I have a recommend list. I also tell you about stocks I want to buy if they come down in price. For example, on Friday, I told club members, you would have gotten this bulletin, that we were buying Morgan Stanley for the charitable trust. To me, this company has done everything right during this period. But because of the inane rotation out of the financials, the stock's been crushed. Now, get this. Morgan Stanley sells for just 12 times earnings. Most of the NASDAQ stocks I look at sell at least 30 times earnings. This is at 12 times earnings, which is a pittance versus that high-flying NASDAQ cohort that had been running until today. If Morgan Stanley stock keeps coming down, I'm confident that I'll keep telling club members to buy it because it's so darn cheap. Hey, how about this one, Centene? You know this has been my favorite health insurer for ages. It's run by the great Michael Neidorff. We have him on every quarter. Centene mostly manages government-run health plans, so they'll benefit enormously from any expansion in Medicare or Medicaid, and those are two things that the Biden administration is actively pushing for. Admittedly, the stock's only down a few bucks from its high, but what I care about, again, is the ultra-low price-to-earnings multiple. Remember, that's the real fundament of stocks. Centene sells for just 14 times earnings, even though it's buying back stock hand over fist and has a very good growth rate. Neidorff is a steady hand, and his recent acquisitions are working out splendidly. Now, here's a real odd one. When I hit it up, I couldn't believe myself. Johnson & Johnson. After delivering an amazing quarter, and there was no one who disagreed with that, J&J decided to break up into fast-growing pharma and bountiful consumer packaged goods companies. While the stock initially spiked up gigantically in this very good news, it's since come straight down. But that's not anything having to do with J&J. That's part of this vicious rotation I'm talking about, the one out of solid Dow stocks like J&J into anything related to semiconductors to the cloud. But we don't have a spike in interest rates, which makes J&J's 2.7% yield pretty enticing, especially because it's got such a great balance sheet. This breakup happens to be CEO Alex Gorsky's last major move at the job. So to anyone who's selling the stock here, will you please ask yourself, if you trusted Gorsky this far, how can you not trust him all the way? As I see it, the spin-off consumer products company, think Band-Aids, Neutrogena, Listerine, Tylenol, that'll be a consolidator in the industry. More important, the pure-play drug business that will be left will be the fastest-growing big pharma company in the universe. It should become an instant market darling. Its valuation has been held back by the consumer products division that's being spun off, which is why J&J, despite its incredible balance sheet, its incredible growth, its great management, sells for just 16 times earnings. I mean, 12, 14, 16. What else? Lately, omnichannel is finally getting its due as people realize the importance of e-commerce, right? You see that at Macy's last week? But you know what makes e-commerce possible? It's the freight companies like United Parcel. Now, here's an investing club name that has just delivered a universally acclaimed quarter, okay? One that helped send the stock from 180 to a new to 210. But, you know, it one time was up at 220. It's pulled back, and I think it's the right level. Remember, CEO Carol Tomei has promised us a good holiday quarter, and I think she's more than earned the benefit of the doubt. With the rails roaring, I think that UPS is now going to catch fire, a fire that burns for days, if not weeks, right into the Christmas holiday. Now, you might be asking, why not recommend some of the stocks that are really being shelled, like the payments companies that you know I like, or some of the travel and leisure names? Now, there are plenty of them that do make sense, but honestly, see, I'm not trying to make the hard money. I want what I call the easier money. The easier money means that these companies already beat the earnings estimates. They already raised their forecasts, yet they still saw their stocks get obliterated. Consider it the safe way to play rotation, because we know how these companies are doing. Bottom line, at a time like this, you want to circle the wagons around companies that reported great numbers but have weaker stocks. That's how you play a rotation that's clearly based on forgotten stocks with unforgettably positive stories like Morgan Stanley, Centene, J&J, and UPS.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.